Well, 2014 has been put to bed, so to speak, and what a year it was. It was an interesting end to the year, but now it's time to look ahead to see what we will be expecting for 2015, and there's no one better to help us do that than Craig Alexander. He's Chief Economist at TD Bank. Hello.
It's great to be here, Kim.
It's nice to be here. I'm tired. It's quite a year. 2014 has been quite the adventure.
You know, the last several years have been terribly interesting, and it would be great if the world would be a little less interesting.
Okay. But will it be?
Because there are so many moving parts. I think we're actually in for very much of the same. I think that in aggregate, the big story for 2014 from an economist point of view was the fact that at the start of the year, we had 10-year bond yields sitting at 3%, and there was an expectation the world economy was going to actually pick up a step in 2014. We would probably see bond yields head a little higher over the course of the year. And in fact, all of these expectations were completely disappointed. The world economy actually decelerated a little bit in 2014, only by about 1/10 of a point. But the main message is the world economy was weaker than people anticipated at the start of the year. And this is the main explanation for why we saw bond yields come down over the course of the year. You know, there was volatility in them, you know, from a week to week, month to month basis. But overall, we saw yields dropping. And we saw more concerns about the global economy. And the big story for the later part of the year was the enormous drop in oil prices, once again reflecting weakness in the global economy.
So what does that mean then for 2015? So we've got right now, going into 2015, we've got a Fed that's come out and said that rates will be low perhaps for at least, or rock bottom, I'll say, for half the year, at the very least probably. But then we've got these low oil prices, we've got concerns in Russia, we have China slowing down. What does that tell you about 2015 and how it's going to play out?
Well, I think that we're going to have a very fragile global economy once again. I don't think we're going to see a marked improvement from a global point of view, but it's going to be a very uneven performance. And I think that the economic differences are really going to stand out. I think one of the big stories is going to be the U.S. economic outperformance. And I think financial markets are already anticipating this. But that is really going to be a dominant story in the coming year, because I do think that the pieces are all falling into place for the U.S. economy to shift up from a trend of 2% growth up to 3% growth. And that's why the Fed is likely to come off the sidelines and raise rates in the coming year.
What are those pieces you're speaking of? What pieces are coming into place?
Well, if you think about the U.S. economy from a domestic demand point of view, so you know the U.S. is a very large economy all on its own. And when you look at the prospects for consumer spending, we've had very strong job creation, shows a lot of momentum. We're seeing more job turnover, we're seeing rising job vacancy rates, and this should ultimately translate into higher wage growth. All of that is fundamentally positive for the U.S. consumer that is 70% of the U.S. economy. And then you layer on the drop in gasoline prices we've had. If gasoline prices remain roughly where they were towards the end of 2014, in 2015, that will put another $500 into the wallets of every American household. And again, the U.S. consumer is such a big part of the U.S. economy. This can actually help the U.S. economy gain a step. I think that businesses that are selling to the domestic economy are going to do better. I think business investment's going to pick up. And I think government is going to be less of a drag. So at the end of the day, I think the domestic side of the U.S. economy is going to strengthen, and that's going to support stronger U.S. growth. What's going to act as a really big headwind is the global economy is likely to remain weak, and that's going to weigh on U.S. exports. The U.S. dollar is likely to remain very, very strong. And in an environment where the U.S. economy picks up to growth around 3%, the job market continues to firm, I think the Fed will eventually come off the sideline. Now, there's a big debate about the timing on this. You know, the Fed has only promised to stay on hold for the next couple of meetings, and that would be sort of the first quarter of 2015. Markets are anticipating the Fed could raise rates in the middle of 2015. My bet is actually they'll wait a little longer. I think they're going to be more patient than people think. And as a result, I think that it's really going to be the second half of next year before the Fed comes off the sidelines. But the really big story from a financial market point of view is that I think we're going to get divergent monetary policy around the world. The Fed is going to be tightening at a time I believe the European Central Bank is going to have to deliver more stimulus. The Bank of Japan is going to have to deliver more stimulus. The Bank of China is going to have to deliver more stimulus. And I think that could be a recipe for some financial market volatility.
Well, we're getting used to that already with at least the end of 2014. We've come out of the calmness. If you go north of the border, I mean, you know, a strong U.S. is good for the Canadian economy from an export standpoint. Low oil prices good for the U.S. in terms of consumption standpoint. What does it mean for Canada? What does it mean for, if you kind of run through the exposures and the ripple effects for housing, for employment, for financial institutions?
Sure. Well, there's two big factors that are going to impact the Canadian economy in the coming year. The first one is the U.S. economy is getting stronger.
Yeah.
And if you think about Canada, we're basically the size of California from a population point of view. We're the size of California from an economic point of view in terms of what we produce.
We don't have the same weather, but anyway.
Yeah, we don't have the same weather, but we're spread across the width of the entire United States. And so if you look at the economic history of Canada, our economy is built along north-south lines, not east-west. And the stronger U.S. economy will lift demand for Canadian exports. At the same time, the drop in energy prices has pushed down the Canadian dollar. This is very good for Canadian non-resource exporters, improving their competitiveness. The headwind on the export side, though, is what's happened in commodity prices. Commodity prices have come down, reflecting a weaker global economy. And oil has come down not just because of weaker global demand, but also because of a glut of supply, which OPEC does not appear ready to address. And I think this has really pushed oil further than it really needed to go. And the question is going to be, how long do those low oil prices persist? I think that, if the market thinks oil should go lower, the market will drive it there. Mm-hmm. The real question is, how long does it stay there? And I think
how long do you think it's going to stay there?
Well, our base case forecast assumes that in the first half of next year, West Texas Intermediate crude is back above $60, and then by the end of the year, we're back up into the 70s.
Which is still low compared to where it's been.
And it is a struggle for our energy sector. They can really cope with 70, 75, but when you get into the 60s, it starts causing a lot of pain. And what really gets impacted is not production. What really gets affected is investment. When you hear people talk about the break-even on energy projects, what they really mean is, what is the price that's necessary to make new investment profitable? And with where oil prices are at the end of 2014, energy companies are all scaling back, delaying big investment projects. So the impact on the Canadian economy is several-fold. The first one is our oil sector isn't going to be getting the revenues they were getting before. So, earnings are not going to be as strong. Number two, governments aren't going to be getting the tax revenues from the energy sector like they were, and this can lead to some fiscal austerity. The energy sector is a big part of certain provinces, and so it'll have a knock-on effect into their regional economies. So this is an environment where we're going to see a very sharp slowdown in Alberta. We're going to see weaker growth in Saskatchewan and Newfoundland. But if you actually look at the Canadian economy, there are some offsets. Oil importing nations oil importing provinces will actually benefit from lower energy prices. Mm-hmm. Consumers across Canada are going to benefit. The drop in gasoline is probably going to put about $300 into the wallets of Canadian households. So that's good for consumer spending. So the negatives outweigh the positives, and we've had to lower our growth forecast for Canada. In September, our growth forecast for 2015 was 2.7%. It's now 2.3%, and that's basically taking 0.4 off almost solely because of oil. But the big impact isn't at the national level. The big impact is at the regional level that's going to impact the economy across the board. You're going to see a big convergence in growth rates. So for example, the Ontario economy, its growth rate, the Ontario economy is going to experience a doubling in its growth rate from 2013. It's going to go from 1.3% last year to 2.6%. And that is a very big acceleration. And it means the first time in 15 years, Ontario will actually be at the top of the leaderboard.
I've only got a couple of minutes, but I remember you and I had a conversation years ago. We were talking about housing prices, and part of housing being, people are gainfully employed. Then obviously housing is fine. When there's a change in employment, that affects, of course, that. So from a regional standpoint, when I hear things about capital spending cuts, I think employment, future projects. What does that mean in a regional basis for housing? Is that a concern?
Well, the first thing to highlight is the fact that although Alberta is going to slow down, it's going to go from a growth rate of about 4% down to about in the 2 to 2.5% range. Yeah. So in actual fact, Alberta will still be growing. What it means is the unemployment rate isn't going to continue to decline in Alberta, but I don't expect you're going to see widespread unemployment in Alberta. But if we actually think about the Canadian real estate market, across the country, it had really cooled down. There was really 3 urban centers in 2014 that was driving real estate, and that was Toronto, Calgary, and Vancouver. Calgary is going to cool off. Smaller bonuses in the oil and gas sector is going to shift down the price point that people are purchasing homes. This is going to cool off the Calgary market. Not a crash, but it'll cool it off. Mm-hmm. I do still think that there is vulnerability in Canadian real estate. I do think that we've had some overbuilding. I do think we have some overvaluation.
As does Bank of Canada.
Although the bank said that they thought the overvaluation was between 10 and 30%. quite frankly, I don't think that's a useful range because, boy, are those different. Our view is it's the bottom end of that range. We think that the overvaluation is probably about 10%, but we do not have a catalyst for a change because interest rates are going to remain low. The Bank of Canada is unlikely to raise rates until late 2015 or early 2016. And if the Canadian economy is continuing to grow, you're not going to get a big unemployment shock. You know, some sectors will be weak, but some sectors will actually pick up the slack. So I don't think we're going to see a sharp increase in unemployment. So I think really, from a Canadian point of view, I think consumer spending is going to be moderate. I think real estate is going to be flat. I think government finances are not going to post surpluses the size they previously anticipated because of the drop in oil prices. But I don't anticipate we're going to be in a large deficit position. But government isn't going to be adding to the economy a great deal. Exports are going to pick up, but I think the strength is going to be in non-resource exports. I do think oil prices have undershot, and I do think that we'll probably see them stabilize and come back at some point next year.
Always a pleasure. Great outlook. Thanks so much.
Oh, it's been a pleasure.
Craig Alexander, Chief Economist at TD Bank.